Hello and welcome to this weekly market recap for the week ending Friday, June 20th, 2025. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com. It's a pleasure to be with all of you again this week. A lot of stuff going on in the market. We'll start off first with the big strike of the U.S. against Iran over the weekend. We saw the nuclear sites. Some bombs dropped in the nuclear sites. Certainly that's going to result in some spike in oil prices as we move throughout the week. That's going to be one immediate impact. And of course, we'll see what kind of retaliation Iran may have and whether or not things in the Middle East continue to escalate or not. Also, last week, we had a big Fed report. The Fed announcement came out on Wednesday. And once again, Fed left the rates unchanged. We did see Fed Chief Powell talk, about continuing to keep rates steady. I don't think the market really enjoyed that. I certainly didn't. I think they're making a mistake. I've talked about that quite a bit. So I won't go into any more detail on that just yet, but I do want to go into a couple of the charts. So I'm going to go ahead and start with that this week. I want to start with the Consumer Price Index, and we'll take a look at how the market finished last week and how certain areas of the market performed. But first, let's take a look at this Consumer Price Index, because this is the chart that I keep going back to, where Fed Chief Powell keeps saying we need to see sustainability. We need to see the inflation rate moving down to 2%. And folks, I'm just showing you the chart here down at the bottom. You can see this is the 12-month rate of change of the core CPI. We were up at 6.7% 3 years ago. And I don't know about anyone else, but what I see is a sustainable move continuing down toward 2%. We are currently at 2.77%, getting closer and closer to the Fed's target. And yet the Fed continues to talk about the fact that we could have another shock, an aftershock, have surging inflation numbers. I'm not seeing it. We're now a few months into the tariffs. We've still seen nothing or very little make its way to the Consumer Price Index. And that's the whole thing. I mean, yes, there are going to be some tariffs that are going to have to be eaten somewhere along the food chain. But the question is, does it make its way to the Consumer Price Index? And at this point, it has not. And the Fed keeps assuming that it's going to, or that it may. And in this process, in my opinion, I think they're leaving rates too high for too long and risking the U.S. economy. Now, this is the same Fed chief that has been effectively presided over our economy for the last 7 years. We've had 4 cyclical bear markets under his watch, 4 of them. And I'm beginning to think some of these cyclical bear markets are his fault, or certainly he's a leading contributor to what's going on here. And we've now had a number of experiences where the Fed has been late to the party. We saw that throughout the entire inflation surge that we had 3 years ago. Remember, the inflation was just transitory. That's what the Fed kept telling us: transitory, short term. Finally, they got it right. They realized it wasn't. By the time they started raising rates in 2022, we were already in the midst of a pretty nasty cyclical bear market. Go back to 2018, the first year that Fed Chief Powell was, filling out his term. I think he started in February of 2018. Remember the fourth quarter of 2018? That was the trade war, tariffs. And Fed chief said back then at the end of 2018 that we were going to have 2 rate hikes in 2019. I wrote in my article saying I just don't see any rate hikes coming. And as it turned out, in June of 2019, we had a rate cut. So once again, I mean, this Fed has consistently shown that it is behind the 8 ball. It continually is late to the party. And like I said, I'm beginning to maybe put some of these cyclical bear markets at the doorstep of the Fed. And some of you might be saying, well, he's just being careful. He's, what's wrong with that? Let's wait and see. Well, I mean, he's costing a lot of people a lot of money multiple different times in terms of these bear markets, these cyclical bear markets that we've been through. And again, 4 of them now in 7 years. Take a look back and see what other Fed official has ever presided over anything like this. The volatility has been extreme. I know he was dealt a rough hand with the pandemic and all, but I don't think he's doing a particularly good job. And I think he's going to be late to the party again. And whether or not it causes another downturn in the market first, we're going to find out here over the next few months. But hopefully it doesn't wait too long, in my opinion. But let's take a look at what happened in the market last week. You can see the S&P 400 mid-cap led, gaining about 0.6%. Transports up about 0.5%. Small caps up 0.4%. And then Dow Jones and NASDAQ 100 both about flat. S&P 500 just down fractionally. But overall, pretty flat week. Market's gotten up. It's trying to make breakouts on some of the major indices. I think we're getting some selling as a result because we're up against some key resistance. And as a result, we just haven't been able to negotiate to get through some of these key resistance levels. If we move down to the sector level, you see energy led last week, gaining more than 1%, which kind of makes sense as Middle East tensions have begun to grow. We've seen crude oil prices rising. And as a result, that tends to lead to energy outperforming. And that's what we saw last week. So energy up more than 1% on the week. Consumer staples up about 0.75%. Then we had materials and communication services both down roughly 0.7 and 0.6% respectively. And everything else just kind of fell in between. So kind of like the major indices, really not a whole lot of movement up or down in the individual sectors outside of perhaps energy, where we saw some strength as a result of those escalating Middle East tensions. Let's take a look at the crude oil chart here. And this is going back over the last 15 years. And you can see we have, big moves down, big moves back up. But for the most part, over the last 15 years, we've been relatively stable in terms of where we are in crude oil prices now versus where we were 15 years ago. When we look at how energy is performing relative to the S&P 500, it does matter which direction crude oil prices are going. So here down at the bottom, this is a correlation coefficient where I'm showing the correlation between the direction of crude oil prices versus the direction. Actually, I'm not sure I got this in here just right. I want to make sure that this is, I want to make sure that's correlating to the energy performance. Let's update this. So I don't have my highlight. Actually, I'll highlight this for you and just kind of show you. Let's annotate this. So what this shows you, this is a correlation between the direction of crude oil prices and the direction of the relative strength of energy. So if we go ahead and fill this in, just going to highlight the positive correlation and the inverse correlation or negative correlation. So you can kind of see the difference here. So when crude oil prices are going down, like they have been over the last 3 years, then energy relative to the S&P 500 tends to go down. That's what this is. That's what this part of the chart is showing. Energy falling relative to the S&P 500. And so down at the bottom, this is a correlation coefficient, which tells us over a 20-week period, this is a weekly chart, and the parameters there are 20. So over the last 20 weeks, this is telling us that we have pretty decent positive correlation between the direction of crude oil prices and the direction of energy relative to the S&P 500. And so as you look at this, I think it becomes pretty evident that whichever way crude oil prices go, that's going to be the tendency for energy to either outperform or underperform the S&P 500. Maybe that's somewhat common sense to begin with, but this kind of proves it on a chart that when crude oil prices go up, the tendency is for energy to outperform. So with this Middle East conflict, one would think that as we continue to see crude oil prices move to the upside, that we will see outperformance in energy. That worked last week. Like I said, energy leading. It was the leading sector last week. And I would suspect that we're going to see escalating tensions and perhaps some higher crude oil prices this week. So as we go into the week, I would expect that energy is going to be among our leaders, at least to kick off the week. And then we'll see, where we go from there based on Iran's retaliation or what they're thinking. And in terms of, what happens in the rest of the Middle East area and the way other countries view what's taken place. I mean, all of that's going to get built into price as we open next week. So that's going to be a big part, obviously, as we go in toward the end of the second quarter. Where do crude oil prices go? Where does this escalation end, or does it end? All these things are going to just add to the uncertainties that we've had in the stock market in 2025. So get ready for another dose of uncertainty. Now, I know that there's going to be a lot of focus on energy. There's going to be a lot of focus on the attack over the weekend, and there should be, obviously. But as far as whether or not the S&P 500 breaks out, I don't think it's coming down to energy. I think it's coming down to technology. So energy may be in the news, and as a result, we might see technology shares sell off. It was option expiration Friday. Typically, we do see areas that have been doing really well heading into option expiration week tend to do a little bit poorly on a relative basis as options expire, and even potentially into the week after options expire. And if you wonder why that's the case, it's because anybody holding options, like in technology stocks, if you're holding call options and the stock's gone up, you have the ability to exercise those options and buy the underlying stock at the strike price. And if you do that, market makers are still on the other side of the trade, meaning they still have an interest to bring the price down in the week following option expiration week. So that's the tendency, or one of the tendencies of the stock market to perform poorly around this time of the calendar month, usually from the 19th to the 25th. Historically, that's been the worst time in the stock market. Going back to 1950, that's been when the S&P 500 has performed its worst, is during calendar months from the 19th to the 25th. And a lot of it, like I said, I believe has to do with option expiration week, and then also a few days in the week following option expiration week. And that's what we face as we go into this week. So those are a couple of things to be thinking about. Now, technology itself represents over 30% of the S&P 500. So what technology does is going to obviously be incredibly important. It always is, as to what we should be expecting for the S&P 500 and for the NASDAQ, where technology is even a larger component. It's more like 50% of the QQQ, which tracks the NASDAQ 100. So here is technology, and you can see right up against very significant resistance. We can stretch this out over a 5-week period, and you can see the tops. I mean, we're right there at all-time highs on the XLK. Do we get through? If we get through, chances are we're going to see the S&P 500 breaking out to all-time highs. If the XLK can't get through and we pull back one more time, then that's when we're likely to see a little bit more consolidation and perhaps a little bit more of a pullback in the near term on our major indices. Now, within technology, we've got two areas that really drive the stock market, that drive technology. And one of those areas is semiconductors. Check out where semiconductors is right now. This group relative to where it has been earlier in 2025, and then also highs in 2024. Pull up a 5-year weekly chart here, and you can see the tops coming across. 21,500 up closer to 22,000. That's where we have seen the tops on the Dow Jones US Semiconductor Index. And we hit a high of 21,406 last week. So we're right up against some massive resistance in semiconductors. It was a year ago, it was in June of last year that I wrote, and I talked about how semiconductors had gone up so much. I mean, we're talking about from 5,000 to 20,000 in this index over 18 months or so. That's crazy. I mean, a quadrupling of the Dow Jones US Semiconductor Index in 18 months. You need to that type of a gain has to be digested for a while. It's hard to just keep going up and up and up. I mean, at some point, you need some sideways action to maybe, to digest those gains. And that's what we've seen here over the course of the last year. But after you have an uptrend followed by sideways consolidation, a breakout can be extremely bullish. And so that's what I'm looking for. I think eventually we're going to get that breakout. My only question is, are we going to get it now in the summer? Or are we going to wait, maybe get it in the fall? That's really the big question. The software group is another group to watch closely, but you can see that the highs that we saw back in December and January, we've already taken out. So if we go back 5 years on software, you can see the breakout that we had over the late 2024 high. So we've already seen that breakout after months of consolidation in the software area. We've already gotten that breakout. Folks, these are the two areas that drive technology, and technology is what drives the market. So we've got the breakout on software, and all we're waiting for is a breakout on the semiconductors. And if we get that, we've already got relative leadership in both groups. I can bring up, let's pull up down here. I'll show you how you can do a price relative. Just pull up the price, pull up the Dow Jones US software, and just put it on a solid line, and here it is. So you can see, and let's annotate this. So I want you to see this relative downtrend that we were in. So from here to here, you can kind of drag that line. So nice little down channel right there, but we've broken out of that. We've got a relative breakout now in that software space. Very similar to like what we saw, I don't know, something like this. See that channel right there? And then let's go up here. And then you see this breakout right here. Oops. That breakout, look what happened to the software group and what happened to the overall market. We came out of that cyclical bear market 2022 with software breaking out on this relative downtrend. And once that happened, market just kept going up and up and up. And now I want you to take a look at what's just happened again. We just had this same thing, cyclical bear market led by software and some other aggressive areas of the market, and then right back to the upside. And, getting back to the Fed point I was making earlier, I know a lot of folks are saying, well, the Fed's got to do what it's got to do and needs to make sure that inflation's not a problem. I would just look at these charts. I don't think inflation's a problem. Why would Wall Street be rotating right now into software and into semiconductors and into aggressive areas of the market if inflation were a problem? This is how you use the charts to decide what's really going on in the news. This is how you find the truth of what's going on. It's not always in the headlines. In fact, I think that's the last place I'd be looking, is in the media headlines for truth. Where you find the truth is on the charts. The charts are telling us that inflation is not a problem. So I don't care what the Fed's saying, and I don't care what the media is writing. We've got growth stocks that are starting to break out of some key areas, software in particular, breaking out to all-time highs. These are stocks that do well in an environment of low interest rates and rising growth, rising GDP. Why would Wall Street look ahead and jump into these stocks if they were worried about inflation? Folks, inflation's not the problem. The Fed is the problem, or at least it's one of the problems. Anyhow, my opinion, you're welcome to your own. You're entitled to your own. But I call what I see in the market, and I call what I see on the charts, not what I'm hearing in the news. All right. For those of you that are new to Earnings Beats, if you go over to earningsbeats.com, you will see, first of all, our website, where you can sign up for a free 30-day trial to our site. You also could scroll down. We've got a free newsletter that you can check out, sign up with name, email address. But what I really want to point you to today, we have a huge event coming up on Saturday. So just under a week from now, Trading the Truth. That's what I was just talking about. Trading the Truth, how market manipulation creates opportunities for all of us. But you've got to see that market manipulation ahead of time. You can't sit back now and talk about all the things you should have done 2 months ago. I was talking about and writing about market manipulation back before the cyclical bear market even got started. Back in January, I was talking about in January and February that being in cash was the right thing to do because of all the risks of the market falling. Once we started to see that market fall, and I think I wrote about it on February 23rd, we saw a huge discrepancy in how discretionary and staple stocks performed one day. And as far as I was concerned, that was confirmation that the top was in and we were going down. It was just a matter of how far we were going to go down. And then early in April, I started talking about, hey, you're already down 20%. We've already had a cyclical bear market. Now's the time you want to be getting in. This is when Wall Street gets in. When everybody is panicking out, that's when Wall Street's building their positions. That's what I'm talking about with market manipulation. If you didn't get it this time, you need to learn about it so you'll get it next time. So right now, I want you to make sure that you get registered for this event. If you go to our website at earningsbeats.com and you click on that link, it'll bring you to this page, which is Trading the Truth. All it takes is a name, email address, and hit that submit button. Make sure you get registered for this event. It's important to register even if you cannot attend live, because if you register, we'll send you a copy of the recording. So please, please, please make sure that you get registered for this event coming up on Saturday. It is going to be a game changer for you. I can promise you that. Things we've talked about, I'm trying to educate folks to try and teach them how you can see the signs of these big sell-offs before they happen. I know a lot of folks out there say you can't time the market. I say BS. Yes, you can time the market. Wall Street doesn't want you to think you can time the market, but all you have to do is follow what they're doing. Follow on the charts, and they'll give you the warning signs that you need to make sure you get out in time ahead of some of these big drops. Anyhow, make sure you check that out. Also, if you are on your phone right now, if you're on your mobile device, go and use the QR code on your screen and use your mobile device and scan that QR code. And that too will bring up the landing page where you can register for the event. I really want to see everybody on Saturday. This is going to be a big event. I'm going to show you exactly, I'm going to walk you through what happened again here in 2025, which was nothing more than rinse and repeat of what we saw back in 2022. I'm telling you, there's a process that the market goes through. You have to understand it. We're going to teach it to you on Saturday. Make sure you're there. All right, last thing to wrap up with today. I just wanted to go through and show you again this leading stocks and leading industry group chart list that we've been doing. I showed you at the top of the show, here's the S&P 500 for the week, right? Minus 0.15%. We have a leading stocks chart list. We call it our LSCL, leading stocks chart list, which we put all of the top momentum stocks in once a week, beginning of the week, and we send it out to our members so that our members always have some of the top performing momentum stocks in the market. There's always something that's working. If you look at this, yeah, the S&P 500 went down 0.15%. We have 34 stocks on this list. ThreadUp, ever heard of that one? TDUP? It's in our portfolio at Earnings Beats, and it was up 19% last week. 19% in 1 week. Jabil reported earnings last week. It was already a hot stock, and it became even hotter after they reported earnings, had a big explosion to the upside. Robinhood, Celestica, these are a couple of other stocks that are in our portfolios where we're outperforming the stock or the S&P 500 right now. Look at these outperforming gains last week relative to the S&P, which was down. Now, is every stock here up? Of course not. We've got a few down here at the bottom. I mean, momentum stocks are going to take breaks from time to time. And last week, quite honestly, with it being option expiration Friday, I think some of these stocks may have pulled back because they were so deep in the money in terms of call options. So a lot of in the money call premium out there on some of these stocks. So it made sense that they would pull back so that market makers would pay out less in premium. And that may continue even into the early part of this week, as I talked about a little bit earlier. But anyway, that's, this chart list comes out to all of our members. We send this out to all of our members at the beginning of every week. And you want to make sure, if you're a momentum trader, you really should have your hands on this list every single week so that you're at least, knowledgeable about what stocks are leading the market. And if you're a momentum trader, this could make a big difference in your trading results as you go forward. Anyway, that's what I had for today. I really appreciate everybody tuning in. Have a great week, everybody. Again, we got more uncertainty now with the Middle East tensions escalating. So we'll have to deal with that. We'll see how the market opens. My guess is risk assets probably would sell off on Monday, but who knows? We'll find out when we get there. Have a great week, and I'll be back next week to summarize it all for you. Happy trading.